Hello, this is Trading Algorithm. You are watching a series of volume analysis training videos. This video will focus on market structure analysis. This is the first step in analyzing charts to understand the current state of the market. In the previous videos, we analyzed order summaries and indicators that will help you analyze a volume chart. Be sure to watch them if you haven't already. In the previous video, we have already analyzed this example of a chart with market microstructure on a second chart for a 5-minute period. As part of the market structure analysis, we can note that the price is usually in two market phases. The first phase is flat. The second phase is the trend. There is an opinion in various sources that the price is in the flat phase about 80% of the time and in the trend phase the remaining 20%. I haven't seen an exact statistic confirmed by history, but if you look at the microstructure, you can understand that these numbers are close to reality. The price is much more often in a flat state than in a trend. In other words, 1/5 of the time the price is moving somewhere and 4/5 of the time the price is not making good moves. This means that if our target is plus 3 ticks, then every 15 seconds we will make 5 trades, 4 of which will not give a profit of 3 ticks, and only 1 in 5 trades can be profitable. And that's if you open a trade in the direction of the momentum, not vice versa. As you can see, our task is to significantly increase the statistics of profitable trades in our favor. To do this, you need to do several things. 1. Be able to identify the current trend in order to catch the momentum. 2. Find the moment when the market has entered the trend phase, which will automatically reduce the number of trades. 3. At the right time, find an entry point at an acceptable price that leaves the potential for movement. From my experience I can say that a very important task will be to find the transition from trend to flat. The first step to profit is the absence of constant losses that lead to drawdowns. As soon as you stop trading in places where there is a high probability of flat, you will automatically get rid of a large number of trades that do not bring results and reduce the commission, which also significantly affects the trading balance. Let's analyze each phase of the market, starting with the trend. The trend phase consists of two states. The first state is a momentum, which should always be expected in the direction of the main trend. The second stage is a correction, which usually takes longer to develop than the momentum and has a much lower potential for movement. From a purely technical point of view, the trend is determined by a formula that was invented decades ago. Signs of an uptrend appear when the previous high is below the new high, and the previous low is below or approximately equal to the new low. For a downtrend, the picture is reversed. During the initial analysis of the market, this is the first thing you need to pay attention to in order to understand what phase the market is in and to further determine its condition. In a really strong trend, during the impulse movement, the elements of technical analysis that are understandable to most, such as channels, trend lines, etc., will not form. An impulse is a time when the market accelerates, a part of traders gets a big profit, the other part gets into stop losses and liquidations. To be in an impulse, you need to enter a trade before it starts or try to take a breakout from the extreme, which usually does not give a good price and significantly reduces the potential for movement. Corrections are more complicated. The first type of correction is fast, characterized by a directional movement of candlesticks in one direction with acceleration and a surge in volume before its end. The volume gradient heat map indicator will help you to analyze any correction and find its characteristic features, such as a volume spike at the end of the correction. This is the easiest correction to identify and trade because it ends quickly and has clear signals at the end. Therefore, it is less frequent than the others. The second common type of correction is similar to the previous one, but it usually lasts longer, the candlestick directions are mixed, and there is no spike in volume at the end. A characteristic feature of this correction is a systematic decrease in volume as the correction develops. The next type of correction occurs in the form of a local flat. There is no clear pattern in the volume, but you can visually identify the flat and simply wait for it to end when a new impulse crosses its boundary in the direction of the trend. There are probably other patterns in corrections, but these three options are clear to me. If you know others, please write in the comments. The fourth type of correction can be called hybrid. It runs in the form of a channel, usually goes deeper than the previous types of corrections, it may contain bursts in the endings, and there may be several such bursts during the development of the correction. It can also be called a trap, because fans of classical technical analysis can confuse such a channel with a new trend and willingly enter into contra-trend trades, which will favorably affect the continuation of the trend in a new momentum. This will happen due to the influx of counter-trend trades and the setting of stop losses at the extremes. After corrections, the momentum should continue. If there are all the signs of a correction, but the price does not develop in the continuation of the trend, then this is the first sign of the end of the trend and the formation of a new balance and flat of the senior TF. In other words, if there is a correction, the momentum should not be long in coming. Now let's analyze the flat phase of the market, or it is called consolidation or balance. From my own experience and the experience of traders I have talked to, I can conclude that one of the most common reasons for a series of losses is to continue trading in the flat after a trend. In this case, you run the risk of losing everything you made in the trend. Therefore, it is important to find the signs of a flat formation as early as possible and stop trading or change your trading strategy. The procedure is quite simple. The first step is to make sure that there is no flat in the market. If it can be seen with the naked eye beyond the limits that the price cannot break through several times. If there is no flat visually, then you need to determine where the current trend is heading, find its last state of momentum and correction. Momentum and corrections are given by the first two extremes. In the example these are high 1 and low 2. At this point you can hold a position in the current trend and wait for a new upward momentum. The third step is to wait for high 3, which is roughly equivalent to high 1. Roughly, this means a few ticks below or above the HI without an obvious strong breakout to the upside. Often, the breakout can be in the form of a small upward tail of the candlestick. After that, there should be a pullback down about 50% of the wave from low 2 to high 3. When we get to high 3, we are very close to the flat and this is a good place to fix part of the position. But the still bullish trend can continue. In the fourth step, we get the low 4 point, which can also be a little higher than low 2, the same or a little lower. After the price bounces back to the 50% width area, we get confirmation of the flat formation. From this point on, it is necessary to stop trading on trend signals as they are most likely to be unprofitable when trading with small stop losses. After receiving confirmation of the flat, you can consider two strategies. The first is to look for rebounds from the flat boundary in the direction of the trend that preceded the flat. This will allow you to find yourself in a position on the strong side if the flat was a stop before the continuation of the flat. The second strategy is to sit on the sidelines and wait for the flat to exit in order to continue looking for entry points in the new trend. Let's move on to examples of chart structure analysis. You need to start analyzing the chart from the senior TF if you are using the senior/junior TF binding. Or load the time frame that is the only one that works for you. In the example, a 4-hour frame is loaded with a scale of 600 candlesticks on the screen. For this frame, 600 candlesticks are enough to find several recent trends and determine the current state. In the example, we can see that there were two trends, the first down and the second up. In addition, we can visually see that a consolidation formed at the end of the upward trend. This can be seen by the fact that the price cannot go up and down from the range that was formed at the top after point 3. For a more detailed analysis of the price structure it is necessary to increase the scale by about 3 times, in my example it is 158 candlesticks. For the sake of clarity, let's analyze the moment of transition from the trend phase to the flat phase step by step. At the beginning of the trend we had several highs, they are marked with high 1, and the first 3 were broken, which cancelled the search for flats in those places. The fourth high was formed at point 1. It was followed by a long downward correction that ended at point 2. This was followed by a new impulse that should have continued the uptrend, but the price was held and bounced down from the resistance zone of point 1. At this point, we were convinced that the buyer was in trouble and couldn't continue the move. Next, there was an attempt to break through the level of point 2, but we got a tail after the candle closed and a rebound followed, forming point 4 and confirming the flat. From this point, we understand that a new position can be formed that will either continue the uptrend or turn the market into a new downtrend. Short-term rebound trades can be considered on tests of zones 1 through 3 and 2 through 4. Since the last trend was up, we can expect it to continue, and buying from support at 2.4 may be promising in the event of an upward breakout. Selling in this structure is the riskiest. In the next videos we will supplement the structure analysis with a volume profile which will provide a lot of additional important information. Let's take a look at the second example of market structure analysis. Let's scale the chart to fit 600 candlesticks and identify the recent trends. We see the last downtrend from point 1 and the current uptrend from point 2. Visually, we can see that the flat has not yet been formed, which means that we are in the middle of a trend phase, and now we need to determine whether it is in the momentum or correction phase. Zooming into 150 candlesticks, we can see that before the current moment, there was a long consolidation that led to the continuation of the uptrend. We can see point 1, which is the last high of the impulse wave. We can also see a small downward correction that ended at point 2, and at the moment a new upward momentum is developing on the chart. There has been an attempt to break resistance 1, but it has not been successful yet, but there has not been a 50% drop to point 2 either, so the buyer has every chance of breaking resistance. If your strategy is based on trend breakout patterns, you should be looking for a buy entry point right now. If you are trading corrections, you are either already in the market with a buy pattern at point 2, or you are waiting for a new correction to find an entry point. In the next video, I will show you indicators that will help you analyze the market structure. They were developed to simplify the process of analyzing the price structure and identifying trend and flat phases. Please support this video by reposting and liking it. Write any comment, you know that it helps YouTube to promote this video. See you in the next video.